Can you see my screen now?
Yes.
Okay, great. I am not a Zoom wizard, so I'm going to do my best to monitor the chat as I'm going through my presentation, but I may not see the questions. So Joe, if you can call them out, because right now I don't see my chat. I don't know what happened. I hit share and everything changed on me. So like I said, I'm not a Zoom wizard. I can't even see myself anymore. So I'm just going to go for it.
I'll keep an eye on the chat for you.
So thanks for having me back. Appreciate you guys being here to talk about Zoom. After last presentation, Peter and I sort of talked about what else could be useful, just as I know you guys are always interested in having presenters. And we sort of talked about doing fundamental analysis and talking about that. I know some of you may get questions along the lines of fundamental analysis in an interview, and just in general, we thought it would be helpful. So I'm back. This is, I promise, the last time you'll have to hear from me. So my first presentation was about, creating a strong investing foundation. The second was about rules and guidelines, really to achieve higher returns and managing your risks. Today we will, like I said, focus on fundamental analysis, really what it is not, and how we can use it in our decision-making process. Today we're going to talk about Zoom. Actually, last time I spoke, I think Zoom really got hit hard within a day or two after I spoke. And I took a look at it, and I thought there were some really interesting fundamental aspects to it. And then again, I talked with Peter, and we decided to go forward with this presentation. It's an easy one to do in this sort of format and in a short time frame, time constraint, because it's a pretty straightforward business model, and I think the fundamental issues are pretty straightforward. So I'd like to conduct this a little bit differently. Instead of me going rapid fire through a lot of stuff and then taking questions at the end, after certain slides, I will stop and take questions about those slides. And also I'd like to make it a little bit more interactive, asking you guys questions and having get your input. So first, a disclaimer. I will leave this up here for a few seconds. I think it goes without saying that this is not investment advice. Do not trade on this. If you do, it is at your own discretion, and you take on all the risks related to this. Obviously, I'm not an investment advisor. The purpose of this presentation is really for educational purposes. I have done my best to have accurate calculations and figures in this presentation. I did put it together quickly. My job is not a fundamental analyst anymore, and I can't spend the time, I can't spend hours and days fundamentally analyzing a stock anymore, but I can get through things pretty quickly. So, have no fear. I did go through things diligently, and I do think these are accurate, but again, there's no guarantees, and in general, you should check other people's work, or not even rely on other people's work to begin with, and doing your own work and coming to your own conclusions. So with that, what is fundamental analysis? So I would say most people use fundamentals in some form or another as a basis for their investment decision. But what is it really? And so first off, fundamental analysis is an opinion. And it's based on your analysis of facts and, quite frankly, other opinions that you read or hear from other people. Research reports, news articles, Wall Street bets, hot stock tips from friends. These are all opinions. Fundamental analysis is also selective. It's not all-encompassing. It's impossible for you to research and know all the information about a company. You will always be missing things. The hope is you can focus on the things that matter, and selectivity is less of an issue. But there's always inside information. You're never going to have access to everything. And you should also be aware that when someone is giving you their view on a stock, you're also getting a selective set of information. They're leaving things out. Some of them may be key things that you would like to know, but it contradicts their opinions. This presentation today certainly will be selective as it relates to Zoom. So fundamental analysis obviously is not fact, it's an educated guess. I would say on that, the more that you can think about ranges and scenarios, I think the more affected your quote unquote guess, will be. There's too much emphasis, at least on the sell side and research reports on point estimates, whether it be target prices or earnings estimates. And finally, fundamental analysis is justification. Like I said, many, if not most people, trade on some sort of fundamental view. People like stories, and that's what attracts them to stocks. So here's some of the risks of fundamental analysis. The first is obviously your analysis is wrong. I think that's pretty obvious, or potentially something changes that, you did not expect. Another risk is what I would say is analysis paralysis. I'm sure you're all familiar with the term, but the more you research and potentially go down a rabbit hole on a stock or an industry, you can have almost an overload of information, which can sometimes make it hard to even make a decision. Or you have so much information that sometimes you overestimate the less important factors, and that can overly influence your decision. The third I have is attachment, and I know I spoke about this in prior discussions. The more you research a stock, the more that you can sort of get wed to your beliefs, and it can make you more reluctant and harder to change your opinion and admit you're wrong. So this is really like a behavioral psychology concept. And finally, another risk is bias. So there is a lot of bias that permeates fundamental analysis. Management certainly are going to give you biased information for what they disclose. It's always going to have a positive spin. But there's also bias in what they don't disclose to you. And so you need to be aware of that. Online forums are also people just putting their opinions which have bias. Or you may develop bias, or someone you talk to as an investor based on your investing experience. And of course, sell-side research, if you read any of those, but there is certainly an inherent bias there as well. So how do I think about fundamental analysis? And I realize the prior slide, it may have seemed overly critical, but I think it's also important to be realistic about what fundamental analysis is, and understanding how it's helpful and what the sort of pitfalls are. So really how I think about it is trying to keep it simple. So first off, I sort of listed 6 points here. And the first is really understanding the business model. How does the company make money? And also, how would you characterize the business? I would say that businesses sort of fit into different types, if you will. And so that can be helpful to think about, hey, it's this type of business. Let me potentially think about other businesses that are similar and how maybe they progressed over time, or what happened to their fundamentals as they matured or through their growth phase. So a second aspect is this focus on the main drivers. Typically there are just a few that matter for a stock. And it's important to just focus on those. And again, don't go down that rabbit hole and make it more complicated than it needs to be. Third is to really understand the risks well, and also their associated probabilities. You certainly don't want to focus on a risk that maybe has a very low probability and a very low impact on the company. Obviously the tricky part is low probability with potentially high impact. So the fourth I have is sort of earnings potential. Thinking about this in terms of short-term and long-term, and again, think in ranges, not point estimates. So then we can take the sort of longer-term earnings scenarios that you have and think about what could the stock be worth in several years' time. And I would say, make sure you're focusing on, the probabilities, ranges and the different scenarios. And I see this all the time of people just focusing on the best case scenario. Make sure you're not just relying on the best case outcome in your analysis. And then finally, this is sort of fundamentals. It kind of gets into, I guess, technicals a little bit, well, kind of marrying the two of what's priced into the stock. And this isn't always an easy thing to know. You know, sometimes you think for sure a stock's going to go up on news because it's great, and then it winds up going down, right? So sometimes it's hard to know what's priced in. You know, bringing in this sort of chart analysis can sometimes help here, as I sort of talked about before. Okay, so here is just a fundamental checklist. I'm not going to go through these. These are just some other areas that you can dig into, you know, as you're getting, you know, deeper into the fundamentals of a company. And, you know, I would generally say probably the longer your holding period is for a stock, probably the more of these items you will be checking off. And if you're holding something for, if you have like a 3-year time frame, you probably want to know a lot of these. You know, if you're holding for 3 weeks, you probably don't care. So before I get into Zoom, are there any questions or comments or anything on just sort of my basic overview of fundamental analysis? I'll just stop there for a moment.
Yeah, I had a question. So before, when you were speaking about the business model and you were talking about maybe the company we're looking at and looking at competitors or
Sure.
people who had a similar business model,
Mm-hmm.
in the sense of like constructing a model, is that where we would bring maybe in like a comp analysis or like a market multiple to take a look?
I'm less concerned about the valuation multiples. I think those are helpful, certainly. It's more of, you know, how does the business grow over time? So like one type would be the replication model. And that is your restaurants or chain stores, right? So like Starbucks, McDonald's, Jamba Juice, right? Those are all replication models where you build a successful box and then you just build more boxes throughout the country, right? And so you can then look at maybe other replication, you know, so your industry is all going to be replication models, right? So you're naturally going to compare it to, but you can also go across industry. Obviously, like McDonald's is selling food, whereas you know, maybe you're going to go look at Restoration Hardware, right? They're selling furniture, and so you can just sort of look at the progression, maybe as growing pains over time, or where things just sort of reach inflection points for profitability, covering sort of fixed costs. But also, yeah, the valuation comps are helpful. I think they tend to kind of move in cycles and sort of as a group from. So, but yeah, but that's what I mean by that. Or just like if I look at we'll talk about Zoom in a moment, but subscription model businesses, right? So you sort of putting like Zoom is a subscription model business, and we'll talk about that in a few moments. And you can look at what other subscription model businesses get at valuations versus, you know, a non-subscription business. The answer generally is higher because there's higher visibility to revenue.
Got it. Thank you.
Any other questions before we move on? I'm guessing you guys probably cover a lot of this in terms of what you guys do, but. Okay, I will keep going. So let's go through Zoom, just sort of following my basic outline I just talked about. And here I'm going to open this up to you guys, and you know, I'd like for you guys to just give a couple answers. There's no wrong answers. I don't know what the right answers are either. So the business model of Zoom. How does Zoom make money?
It's subscription based, so there's a free one, and then if you want more advanced features, you would have to get the premium versions.
Exactly. And like I said, subscriptions are higher visibility. It's not relying upon utilization. And that generally is looked on positively by the market because you have a stickier base of customers. You're not relying on selling a product every day, every month, every year. People are going to typically sign on to a subscription and keep it going. I just think about my Microsoft Office 365. Every year I'm going to pay whatever it is, $75 and renew. That's a great business model. So obviously, moving to the next bullet point, work from home has obviously been a driver. but what other drivers can you guys think of that would cause a company to use Zoom?
Maybe international business. You can't be face to face with your clients or your people you're working with.
Yeah, exactly. Saving travel costs. You don't have to fly across the globe to talk to somebody, and it's face to face, and there's more value than just a phone call. Yeah, that's a great one. Any others? Okay, so the other only I had, that was kind of two of mine, the face-to-face, better productivity, and sort of business travel expense. The other I have is cut real estate costs. People can work from home now. You need a smaller office. I read an article yesterday about what's the future of Manhattan real estate, given there's so much office space in Manhattan. Are we going to go back to the way things were, or are we going to have some mix of at home, in person? And if that's the case, how much office space do companies need compared to what they have right now? So what are the major risks? There's obviously a very easy one staring us in the face.
Let's say people return into the office.
Exactly, that's a huge one. I think that's like the biggest thing for the stock right now. Anything else?
Competition.
Great one. They have two big competitors in Microsoft via Skype, although Skype has really done nothing forever. And WebEx with Cisco. It's actually where the founder of Zoom came from. I actually was invested in Cisco back when they were promoting WebEx. God, I don't even know how many years ago. Potentially 10 or more. WebEx has this big push to large corporations, and their pitch was, travel. Look at all the billions of dollars you spend on travel expense every year. To date, Zoom has crushed the competitors with a much more user-friendly product, but Cisco doesn't lack for money to invest in product improvement. Anything else?
The privacy and security issues.
Yeah, it's another great one. Absolutely. We saw that come to a head and they made some changes, but there's no reason why that can't be a factor again. Any more? Okay, my last one, Zoom fatigue. We talked about it before. People are just getting tired of doing Zoom. And I don't know if you were on when I mentioned it, Citigroup has no Zoom Fridays. People, it's a lot more fun to be in person. So here we're going to move to sort of their earnings, sort of the next thing on my outline. And we can sort of think about sort of the risks and drivers that we just talked about, just, help you obviously frame and think about forecasting their earnings for the near term and the long term. Near term is important for timing your purchases. And the long term is, what's the potential valuation? And it's really like, do you even want to buy the stock to begin with, right? If there's not the long-term value there, it's not even gonna be interesting. So I just wanted to post the consensus forecasts. I pulled these down. Oh, I might have pulled these down a week or two ago. They're probably still close. But as you can see, they are not forecasting a decline or flat. They're forecasting pretty good growth for the next couple of years. And fiscal 22 is pretty much calendar 21. Their fiscal year ends, I think, early in the year. So think about fiscal 22 as calendar 21, and this is calendar 23 is calendar 22. Just confusing. So before I move to sort of a little bit of a fundamental disclosure on revenue, I'd like to get a couple different opinions here. What do you guys think is going to happen in the next year for Zoom's sales and earnings? What's your expectations?
A major decline as everyone returns back to in-person.
Okay.
I think people are just going to start using Microsoft more because it's so integrated with Excel and everything. It's just easier to have one platform across the board to just use Microsoft instead of using Zoom.
Okay.
That also goes for Google Meets for companies who use Google more often.
Mm-hmm. So big decline. Does everybody think that is the case, or do some people think they're going to keep growing like these consensus forecasts say? And it's okay to think that. That's what the street's telling us that. I'm not saying you're wrong. I don't know what the right answer is.
I think one thing they do have a value is they're almost like first to market. Like if you take Uber, like even though I only use Lyft, I still say I'm going to Uber. People will still, I think, say, oh, we're going to do a Zoom call, even if it is on another platform, even if it's just socially, not so much in the office.
Mm-hmm. Yeah, I think video conferencing is here to stay. It's just a question of to what magnitude. So, okay, so let's move on to the next one. So hopefully you guys can go through this as I talk. So I came across these disclosures, and there are several different disclosures, but I just thought that these were interesting. And I pulled these from the management presentations and also their 10K. Actually, no, I pulled it from the IPO prospectus. They might be in the 10K, but I didn't get it from the 10K. And I'd say this is an example. My goal here is show an example of how you can take company disclosure and it can help you frame your thinking. So I thought these were two really interesting disclosures about their revenue. So the chart on the left is revenue, percent of total revenue from large and small customers. And then I annualized the revenue because it's a subscription based. I think you can annualize this business pretty closely, right? There is some one-time big event stuff, but I think it's largely an annualized business. But you can see, so 4Q20 is basically the quarter before we went into lockdown. And obviously 4Q21 was what they just reported not even a month ago. And, there's a huge change here, right? So small customers went from 20% of revenue to 37% of revenue. And I don't have this stat in front of you. I wanted to keep as little numbers as possible. But basically, revenue growth from small customers grew at just under 3 times the rate of large customers. And they define customers as businesses with 10 employees or less. So 11 employees is a large customer. So there's probably still a lot of small customers in the large customer bucket. So I look at this disclosure and I say to myself, well, how many businesses with 10 people are going to need Zoom when we all go back to work? Right? I don't know the answer, but it helps me realize that, hey, 37% of their revenue is from a customer base that potentially everybody's going to be in person together going forward. And so you can take that number and incorporate that into your thinking. So on the right side, I have percent of revenue by term. So they have annual and monthly contracts. And we sort of have a trend that changed from 2019 to 2021, where they're just generally increasing monthly customers versus annual. But the COVID impact is really here. I don't know if you can see my cursor moving from kind of the 40 to 50%. And these are not specific numbers. They're sort of numbers that they give in passing. And it's not applied to all of 20 or all of 21. This is like one of those sort of soft numbers that you kind of put into your thinking, but they're not precise. So potentially, there was a 10% bump in monthly users relative to pre-COVID. But again, there's a trend going on here. So, I wouldn't just automatically say that this is all COVID related because there was a trend going on here. But this is like something that if I talk to the company, I'd be like, what was the trend before? And again, the problem is then you're relying on the company's spin, right? We talked about management bias. But this is something that, again, is interesting. Nothing may come from it, but it's something that I think is interesting to think about and look at. You know, if we were to assume that this is all COVID related, it implies monthly users grew at just around 1.5 times the rate of annual contracts. And again, the question I ask is, if I want flexibility, I'm not in this for the long term, I go to a monthly contract, right? So it's just another way to think about the potential sensitivity of, as we go back to work, what percentage is going to stay, what's going to go. You know, there's other disclosures I don't have in here. They talk about, you know, really large customers. They talk about $1 million plus accounts. You can factor those into your thinking as well. My recollection is like the really big enterprise customers, it's only like 14% of the business. It's great. That's a nice solid customer base to have, but it's still small relative to the grand scheme of things. So, you know, I threw out some numbers. Do you guys have any questions on this before I move forward? Okay. So, okay. So we did short term, and now, you know, let's think about long term. And I'll just say up front, this is obviously $5 to $30 earnings range. It's ridiculous. I did that on purpose. I don't want anybody focusing on the results of this analysis. I don't want to have somebody say, well, Chris said it's going to earn $6, right? And there's no forecasting here. So the range is ridiculous on purpose. So I'm just trying to think about what could the company earn in 5 years? They give a 23 billion total addressable market TAM by 2024. I'm just going to say 20. I'm just going to use a 5-year in my forecast, all the calculations, because I just like thinking about things in 5 years, not 4. I don't think it's material difference. So what can the company earn in 5 years? So I'm basically giving you earnings that are coming from 3 assumptions. And this is an easy analysis. Not all companies are this straightforward. So you have a 23 billion total addressable market. So what does that mean? In, let's say, 5 years time, if everybody that is a natural or a target video conferencing and phone conferencing customer, the revenue would be $23 billion. So then the second assumption I have is, what's Zoom's market capture? You know, market capture is really, think about it as their market share times the industry penetration. You know, obviously this is, so you can also call it market share, you know, whatever you want, but I just did it as market capture. So what percent of that 23 billion do they realize as revenues in 5 years? And then the third assumption is profit margin. I give you 2 here. 25% is what they disclose as their long-term profit model. This was in their Zoomtopia analyst presentation from last fall, I believe. And the 40% is basically what they're reporting right now. So they're telling you their margins are coming down over the long term. They could be conservative, or that could be accurate, or we have no idea because it's 5 years from now. So it's a pretty simple calculation. 23 billion times this market capture times profit margin gives you an EBIT. They're not paying any taxes. There's really no debt. I assume they continue to pay no taxes. Again, I don't know what their tax position is. Maybe they start becoming a taxpayer and this number is actually lower. Again, the numbers don't matter, right? We're not trying to trade off of this. We're not trying to do a research report. It's the process and the outcome that matter. The process is important. And so they were coming up with earnings estimates based on these simple calculations. Now, I would add 100% market share or 100% market capture is an impossibility. As you have mentioned, there are competitors. There are large competitors. The last disclosure I found was Cisco has like something north of $1 billion of revenue. So other companies are going to have some revenue, and there is going to be some segment of the addressable market that just never adopts video conferencing, right? So the 100% is like the impossible best case scenario. But as you'll see, I think that's interesting as we go through our analysis. Did anybody have any questions on this before I move forward?
I do.
Go ahead.
So the profit margin, you know, right now 40 and management gets it to 25. There are two things. One, with a company like this, you would think that a lot of the outlay has already been done, and so they would be able to grow margin. But on another level, how would you go about this? Is somewhat unique, but not really. They're competitors. So you have Google, obviously you said Cisco and others. Let's say none of them separated their video conferencing in a way that you would, you know, be able to understand what their actual margin was. How
Right.
might you go about for a new industry like this coming up with a profit margin?
For me, what I would do is I would just do what I'm doing today is scenario analysis. That's, but you could certainly, I mean, to really get a great answer on that, you got to start talking to like industry consultants or industry experts to understand what's the cost of ramping this up. Or you could, I mean, you can try to talk to the company to understand why they think margins are lower, but again, you're relying again on company bias. My guess is people aren't so price sensitive right now, right? They might be in a couple of years, especially as the competitors ramp up. My guess is that's a good chunk of it, is just the price aspect of it. You know, for 1 year, I don't care what I'm paying. I need my people to work. You know, if this is a long-term investment decision for a company, it might be a little more price sensitive. I don't know if there's higher acquisition costs, you know, to some extent. I think about, yeah, we have run rate of $3.5 billion in revenue. They were like nothing 2 years ago. But I also say to myself, you're not on Zoom now. What's going to make you go on Zoom? Right? It's going to be potentially a harder sell to get to 5 billion in revenue. I don't know. And that's going to take more money, maybe more salespeople, you know, knocking on doors, visiting clients and selling them on the prospects of this. Yeah, it's a hard question. I think there's part of the reason there's such a wide range here is I think it's really hard to know what's going to happen. What are margins going to be and how much? I have no idea what the market capture is going to be. But I think, as you'll see, these very optimistic figures are informative as we think about the stock price.
Thank you.
All right. So this is very simple, and I will go quickly on this. So then I just take these crazy wide earnings forecasts. I put these PE multiples on it, and this just tells you which scenario it is. So 25% margin, and this gives you a stock price, right? You can choose your own PE, choose your own market capture. Obviously, you do your own analysis. Again, very wide assumptions. Did that on purpose. We have anywhere between a $100 and $900 stock in 2025. I recognize that is not helpful at all. I see Joe laughing. So how do we take that to the current stock price? Well, it's just net present value. So I take that this table above, and I discount everything by 15%. And let me look at my notes so I'm not missing anything here. I actually just sort of touched on a lot about this. So what's the current stock price? $300. Well, it's close to this, but can a company get 100% market capture? No. So where is 300 in my table? That's out here. Again, this column is impossible. Yeah, it could be 90 maybe. That's still probably high, especially in 5 years. This is a pretty good scenario that the stock is pricing in at the current price, or this is not what the market's thinking. It's a much lower discount rate, you know. So maybe they can achieve this 50% and a 25 PE, but you're just going to get a low return. Maybe it's a 7% return on the stock price from here, not 15%. Again, this is just a round number in the sense that it ends in 5 that I put in here. It's not the number I would use. I don't want to give you guys my forecast for good reasons. You pick the discount rate that you think is most appropriate, and your table would look different than mine. And where'd the stock peak? 580. I don't even have 580 on this chart. So what is it? What does that mean? It's just something to think about, right? Now I had 580 here, right? There's 580 here on the 5-year price target, right? So you can get the 580, but again, if we can hit these 580 scenarios in 5 years, this is telling me that there is very little return to owning the stock at that price. Again, assuming this analysis is correct. I don't think I'm crazy, but I could be wrong. Any questions on this before I go forward?
I just want to say this is kind of a big concept for us, especially being in school. So maybe take 30 seconds and see if it kind of hits you, and feel free to ask questions. It's a good time to. And we use this in S&P, this almost the same setup with, so really try to take a second.
Again, really just the concept is, what could it be worth in 5 years based on those earnings? Discount it back to today. And that's your return of holding the stock, assuming you get that 5-year price target. Obviously, it can be up higher, it could be lower, it could be negative. But again, it's what I took away is that at the peak, Zoom was pricing in an impossible, well, not an impossible scenario, but basically very little reward with a lot more risk. You know, I think Cisco is like the classic example of the .com bubble in 99, 2000, where it was like, it was pricing in a revenue for Cisco that was like impossible. It was like GDP of countries, like it was ridiculous. And so this is just a way to sort of think about what is realistic and related to the stock price. And actually, I thought the most interesting is working backwards here. So not here, starting from the revenue sensitivities, then coming up with the top down TAM and this. It was like starting from the stock price, where does it fit into my NPV table? What does it mean for the future price? And what does it mean for this, right? How optimistic or pessimistic is the stock being at that point in time? So like working backwards in a stock like Zoom, to me, was more useful than working top down, as you traditionally would. All right, I'll go to the last slide. Sorry. And then we can obviously open up for more questions. Before I get to this, I want to talk about sort of a key piece of information. So leading stocks that lead the market, your hot stocks, your best performers, the ones that are in the news. So statistics I have seen is that once a leading stock peaks, roughly 3/4 of them drop by 50% or more, and roughly half of leading stocks drop about 75% on average or more. So what does that mean? I know right now, really hard to imagine that. What are the leaders? Facebook, Amazon, Netflix, Apple, Tesla, PayPal, NEO, First Solar, Zoom, keep going. It's really hard to imagine that some of these stocks could drop 70 to 80%. But statistics say that one or more of these stocks is going to go down 70, 80% from its peak. I have my suspicions which one. I leave that up to you guys to decide on your own which they will be. But I would just say when it comes to hot stocks and leading stocks, the market more often than not overshoots to the high side for a number of factors that are just the natural nature of the market. So when you see a hot stock and it's down 20%, you're like, oh, this looks like a great buy. Just make sure you're not catching a falling knife. It's a very important concept to be aware of. So here, just gonna take a little look at the chart. And this is what I do. So I'm just kind of, it's fun for me. Hopefully it'll be helpful, sort of talk about marrying charts and fundamentals. I was going to go through Tesla too, but I don't even want to touch it. So I'm just going to point through a couple things that I look at, and I recognize this is hindsight. You'd be like, oh, Chris, you know what happened. So this is BS, right? You're in hindsight, so you're going to sound smart because you're just pointing out what happened. It's not the point. The point is to kind of look at the chart and study it. You know, I'd say studying leaders, market tops, market bottoms is a very constructive exercise because it can show you how stocks act when they're topping, or maybe at the beginning of their run, and you can sort of use it as a framework for next time you see a stock like Zoom. So I'm over here. Hopefully you guys can see my cursor, right? I'm going to go with yes. So the first thing I want to point out is this bar right here. This was September 1st, I believe they reported earnings. This is a weekly chart and it's in log scale. The two blue lines are the 10-week, which is the 50-day, and the 40-week in red, which is a 200-day. So here we have the largest weekly price bar on the chart. Well, since here, this is like, I think this was COVID, right? So this is kind of different. It's the largest weekly bar, huge weekly volume, closed just under the midpoint of the range. This bar, my cursor keeps going in and out. Hopefully you guys can see it. It's the one with the 478 on the top. This was your first warning that the top was coming, because you had a huge price range and huge volume, which means there's a big difference of opinion in the market right here. The characteristics of the stock, this lets you know the characteristics of the stock changed. This doesn't mean this is a top, but it's a warning sign to you if you're in this stock. Now, you know, the stock kept going. If you look at the daily chart, it actually gives you another warning sign, because you can see that the price bars and the movement of the stock appears to pick up in volatility. You know, relative to what is here is just sort of like, you know, nice, decent ranges, gets a little volatile here, calms down, and then it really swings over here. You can really see it on the daily charts if you guys take a look. So the next thing I thought was interesting here is when we made the top. You know, obviously we're going up, we made all-time, so this is a weekly, we made a new all-time high from the prior week and slammed down to the low of the week. So the market rejected this high price and put it down to the bottom of the range. Now, if this was on even higher volume, that would be a louder sign. This is kind of a subtle signal. You know, the signals are different in every stock, but we're just sort of reading what happened. And again, it's 2020. I'm not saying I would have noticed this in real time. I'm just saying we look back and then we use it as education for the next time. So it got slammed again, bottom of the range. Again, low closes are a weak sign. Doesn't mean the stock's going down, but it is a weak sign to be aware of. So then we tried to rally back up the following week. Very weak rally. You see here, volume decline. Buying on buy, it's basically on buy balance volume is lower than our selling here. And the stock recouped less than half of its decline and then just came down. Now what we have here is, I think this was anticipation of Pfizer's announcement that the vaccine was effective. So I know we talked about it last time that can't always wait for the news. The market, I think, was pricing in the vaccine before the announcement, which is this bar. So, you know, the stock then tried to reclaim its 50-day, you know, actually had a good, well, it popped through. Now this is probably going to get people bullish, right? We popped through, we had a really good close. But look at the buying volume down here. Right? Look at the buying volume compared to other leg ups in the stock, right? Here, look at how big this volume is in this up move. Look at this volume back here and this move in the stock. Pretty weak volume here on this move up. That's not a strong move up. So the stock, you know, never made it back to this swing high. And then this is right when we spoke. If you look in daily, it popped and then got slammed down the next day. Another week price action on pretty high volume. And if you look at since November, 3 biggest volume weeks are down weeks, and down weeks with, you know, 2 really bad closes and 1 sort of middling close. There's a lot of going on here with the vaccine announcement. But that's sort of how just a rough kind of looking at some price and volume and how you can try to interpret what's going on. Now the stock it's a little bit lower, maybe $10 lower today. This is Friday's close. Now it's also spent 1, 2, 3, 4 weeks below its 200-day moving average. It's not a strong place to be for a stock. You really want a stock to be above its 200-day moving average. What's going to happen from here? You know, it sounds like people think things are going to go down. Sell side doesn't believe that, but they don't always write what they really think. But it's it'll be interesting what happens. But I just wanted to run through kind of a few signposts, you know, that I saw, you know, on the chart. You know, one other thing I would point out, and this was I noticed this in Tesla too. Tesla's a little bit harder. I'm not even really sure that there's a good signpost in terms of giving you the market top, the price top sign. I think Tesla's top in the interim as well. That's not saying it can't go back to where it was, but I think in the interim it's probably topped. I would say here, you know, look at all the, oh shoot, what did I do? Sorry. Look at all these weeks, right? Look how gray, which means these are up weeks. And then the composition starts changing, right? This is probably more down weeks than up. So that's just another clue of the character of the stock has changed. And Tesla showed this as well. During its run up to its high, it was like very heavily on buy days. I didn't look at the weekly. And then you start to see the characteristic change where there's a lot more red mixed in than it was before. So just seeing, you know, the number of up versus down weeks, that percentage change, or where a stock closes in its range, you know, moving from maybe high to lows, you know, that's characteristics of a stock that could be changing. Again, these are not forecasts. It's not saying that, oh, this happened, therefore the price is going to do X. It's just things to think about in your investing. So that is what I had. If anyone wants to ask questions on this chart or anything else, please fire away.
Yeah, I have a question. So last time when you spoke with us, you mentioned like maybe good entrances on positions is a tight price range but low volume. On this
Yes.
chart, do you see that maybe before 2020? Is that maybe in 2019?
Yeah, you had it. I mean, you don't always get it. Let me stop my share. I'm going to escape. Let me close out of this. I'm going to just bear with me for a second. I'm going to go through Tesla because it actually shows it. All right. Can you see my screen?
Yes.
Okay. So this is right before the run up, and let me move to a daily because I think you can actually see it there as well. So here you see what I am moving my cursor over.
Yes.
Okay. So just bear with me. So we have 502, 329. This is a high of 457, low at 351. This is a high of 448, low of 428, then 465, 479. But generally, look at this. It's tightening up. Does a little dip, which is actually not a bad thing if you're looking at stock, because this little dip can shake people out, shake out the weak hands that don't believe the stock's going up. But then as we get here, look what happens. It's really tight. And I apologize, this is small, but look how tight, if you can see it right here, I'll give you the date. You can actually look it up on your own. 11/16/20. stock price range for the day was a high of 412 and change, a low of 404, $8 move on a $400 stock. Tiny, bam, what happens? Comes out of here and explodes up. All right, so this is just randomly, Joe, great question. Had this example in front of me, tightened up and just exploded out. You see it, the volatility contracts, you have balance, you have a lot of balance here. That next move, I'm not saying it's 100% chance or a 90% chance, but there's a good chance it's going to make a big move, and there's not a lot of risk, you know, whatever, reasonable risk. And look at that. I mean, they don't always work out like this, right? This is an extreme example, but this is a great example of a stock tightening up and exploding. And I think Tesla has done that actually a couple times before.
Thank you.
Yep.
A point on Tesla, and this could go in a number of ways, but I want to be respectful of Chris's time, so only one or two more questions. But we were talking about this the other day, and Tesla is, or at least at that moment, was valued more than all of the German car companies combined, and more than Toyota and Ferrari combined.
Right.
So
yeah, I mean, the Tesla analysis is the same as Zoom, just harder, more in depth to. Well, I got to throw a lot more on the screen to go through Tesla than I do for Zoom, so we did Zoom. I think Zoom is also less controversial, so it's easier. But yeah, I mean, Tesla, look, it can go back here. Anything can happen. But I mean, I was going to talk about this. I'll throw it up here now that I have you guys on this page. Yeah, so we've seen, I mean, you can just see there's more red sort of creeping in. You had really good periods of blue here. But the other thing, Joe, I'd point out on this little time frame that I indicated, and this is actually a very important point, I apologize for neglecting it. We had the tightening of the stock, but look what the volume did, if you can see this. So this volume's on a log scale, which shows it better than the Zoom chart in the presentation, which is not on a log scale. Look how little volume's down here, right as it contracts. Smallest range and tiny volume. You know, a couple days before that smallest range, volume was 68% below average. That means nobody's really doing much in the stock, and it explodes out. That's a pretty good pattern to find. And there are ways you can screen for it, basically looking for narrow price ranges and volume declining. You know, I guess the other, just sort of, I'll go off the cuff here. I don't know if anyone else has questions, but you know, the other thing, again, it's hard to find like where is Tesla announcing it probably topped. You know, you had this day where it made a new high and got slammed down, came back, albeit on, again, you have like lower volume here to make another new high, you know, new highs on lower volume. New highs, you want to see higher volume. Maybe that's a sign of it. I don't know. But generally, as stocks make new highs, those new highs are stronger if you have good volume. You know, then came down again. But again, it's not coming down on high volume. In fact, there's like, you know, volume just here is kind of decreased relative to where it has been. You know, maybe that's, so the stock could have maybe just come down from an absence of buyers, right? Like maybe this peak, you just kind of ran out of buyers, right? There's not a lot of volume. You know, I'm certainly seeing call volumes are coming down. That's the big tool of retail traders, buying small lots of out of the money calls. You know, that's really been coming down. It kind of started around February. You know, sort of came back here again, trying to get back to the high again. Look at, so this is really low volume trying to reclaim its high. And, you know, I'm not a Head and Shoulders expert, but we made a peak, a slightly higher peak, and then another peak. Maybe this is some kind of really condensed Head and Shoulders. Usually you get a longer time period for Head and Shoulders. I think, I'm not an expert on it, but with this volume, that's a change in the characteristic of the stock. Here's another example of similar where it made a high. Obviously at this point, this is a high. It got slammed down on really high selling volume, right? But then what happened afterwards, right? So we got some selling. And again, this is actually another contraction period in the stock. But then what happened? See here, we went back to new highs on good volume. Didn't try to go back to new highs, couldn't on much lower volume. If you guys like, that's a difference. That's a change in the character of the stock. I think this is the top for now. Like that's how I read the chart. I could be wrong, absolutely, but you can see what the market potentially is telling you, and then it just starts unloading, right? I mean, then we just have a few days of very high selling volume. You know, we had an update here. Yeah, it's below. This is a 21-day moving average. This is a 50-day moving average. Yeah, it's got to recoup this 50 before we even start thinking about it going up. Things can change, obviously, in a month or so. But this is not a chart that tells me it's going back to 900. Again, it can change tomorrow, right? You have to be aware of that. So don't say, Chris said it's topped and it goes back to 900. Be like, he was wrong. Things can change any day. So you have to be aware of that. But with this, I'm just reading to you what I read looking at this chart.
We'll have time for one more question, and then we'll say thanks to Chris.
Well, I hope this was helpful. You know, again, and I kind of went a little bit off the reservation, throwing in some charts at the end, but I just wanted to, you know, it's more, this is what I do now versus the fundamental analysis that I used to do. You know, I kind of marry the two. But I just wanted to give you guys a little bit of an introduction, if you will, since I have talked about it. You know, my prior two presentations, just sort of, again, looking at the market and kind of reading the signposts that it might be telling you. So I hope, hopefully maybe I got somebody interested in maybe looking at this a little bit more, because I do think it's helpful. But if there's no other questions, I would say thanks for having me again. I always enjoy coming on doing this. And, you know, for those graduating, you know, obviously best of luck in your careers. And for those here next year, maybe I will see you again in a year. But thanks, guys, and good luck with everything.
All right. Thanks
Thank you,
again, Chris.
Chris.
All right. Take care.